January 30th, 2026. Silver crashes 31% in a single trading session. The biggest daily loss on record ever. $7 trillion evaporated from precious metals markets before most people finished their morning coffee. Financial media called it panic. They called it a correction. They called it market forces finding equilibrium. But that's not what happened. What happened was a planned execution, a controlled demolition. A perfectly timed heist, hidden in plain sight on the ledger of the Chicago Mercantile Exchange. JPMorgan closed 633 silver short contracts at the exact bottom of the crash. Not near the bottom, at the bottom. Then the price recovered. This wasn't luck. This was precision. This was proof that the entire collapse was orchestrated from the beginning. Let me take you back to when silver seemed invincible. December 2025 into early January 2026. Silver had broken through $100 per ounce for the first time in history. Gold was pushing new records. Precious metals were the story of the year. Central banks were buying. Retail investors were stacking. Industrial demand from solar panels and electric vehicles was surging. The narrative was unstoppable momentum. Silver had climbed from $17 in 2020 to over $100 in just 6 years. A 600% gain that made early Bitcoin adopters jealous. Billboards in Times Square advertised silver investment apps. Podcasts debated whether silver would hit $200 by summer. The metal had become a cultural phenomenon, a rebellion against fiat currency, a store of value in an age of monetary madness. But beneath the surface, the foundation was rotting. The entire silver market was built on a dangerous fiction. For every physical ounce of silver that existed in vaults, there were hundreds of paper claims traded on futures exchanges. The COMEX in New York was ground zero for this illusion. Traders bought and sold contracts representing 5,000 ounces each. But most of those contracts would never be settled in physical metal. They were cash-settled bets on price movements. This created a parasitic paper market that had detached from physical reality. The tail was wagging the dog, and the biggest players in this game weren't miners or manufacturers. They were banks. Specifically, a handful of bullion banks with names like JPMorgan Chase, HSBC, and Scotiabank. These institutions held massive short positions, bets that silver would fall. The addiction was leverage. The entire commodity futures system runs on borrowed money and margin accounts. Traders can control $100,000 worth of silver with just $10,000 down. This creates explosive upside when prices rise, but it also creates catastrophic downside when prices fall. A 10% drop doesn't just cost you 10%. It can wipe out your entire position and trigger a margin call. You either post more cash immediately, or your broker liquidates your position at whatever price the market offers. This is the trap. This is the monster lurking beneath every leveraged trade. And in late January 2026, that monster was getting hungry. The antagonist in this story isn't a person, it's a system. The paper futures market controlled by a cartel of banks that profit from volatility and chaos. These banks don't make money when silver goes up or down. They make money when they can see both sides of the trade. They make money when they can create violent price swings that force liquidations. They make money when they know where the bottom is because they're the ones creating it. And the weapon they use is simple. Flood the market with paper supply. On January 30th, 2026, the COMEX traded 368,561 silver futures contracts. Add in 28,152 options contracts. That's 396,700 total contracts. Multiply by 5,000 ounces per contract. That's 1.98 billion ounces of silver traded in a single day. Let that number sink in. Global silver mine production is 800 to 850 million ounces per year. In one day, the paper market traded more than twice the entire annual mine supply. Where did those ounces come from? They didn't. They're fictional. They're entries in a database. They're promises that will never be kept. This is the core fraud of the system. The price of physical silver is determined by the trading of fictional silver. And when you can create infinite fictional supply with a keystroke, you can crash the price anytime you want. The descent began just after midnight Eastern Time on January 30th. Asian markets opened first. Silver was trading around $102. Then the selling started. Not gradual profit taking, not cautious rebalancing. Massive, relentless sell orders that overwhelmed every bid. By the time London opened, silver had fallen to $94. By the time New York opened, it was at $88. The cascade had begun. Every dollar lower triggered more margin calls. Every margin call forced more liquidations. Every liquidation pushed the price lower. It was a death spiral engineered with mathematical precision. Traders who had been riding the bull market for months watched their accounts implode in minutes. A position that was profitable at $100 was underwater at $90. At $80, it was a total loss. At $73, which is where silver briefly touched, fortunes had been erased. Life savings gone. Retirement accounts decimated. Leveraged traders didn't just lose money. They lost everything and ended up owing their brokers. This is what a 31% single-day crash does to a leveraged market. It doesn't create losses, it creates bankruptcies. But while retail traders were being annihilated, something else was happening in the shadows. JPMorgan was closing its short positions. The COMEX report dated January 30th shows JPMorgan Securities stopped 633 silver contracts. The timing was surgical. They closed at the exact bottom, $73. Then the price started to recover. By end of day, silver had crawled back to $84. By February 3rd, it was at $92. Someone knew where the bottom was. Someone knew exactly when to flip from short to long, and that someone was the same bank that had been selling into the rally for weeks. This is the smoking gun. This is the proof of premeditation. In a truly organic market crash driven by panic, no one knows where the bottom is. Prices overshoot, fear dominates, recovery is slow and tentative. But this crash was different. The bottom was precise. The recovery was immediate. And the bank that had the most to gain from a crash closed its shorts at the exact moment of maximum pain. This isn't conspiracy theory. This is documented data from the Commodity Futures Trading Commission. The ledger doesn't lie. Now let's talk about what was happening in the physical market while the paper market was collapsing. 2,514 silver, February 2026. Futures contracts received delivery notices. That means physical demand was still strong. Real buyers wanted real metal. But here's the problem. Delivery times had jumped to 8 to 16 weeks. Dealers were suspending sales. Inventories were vanishing. The physical market was acting like there was a shortage, while the paper market was acting like there was a glut. This is the ultimate proof of disconnect. And then there's Shanghai. While COMEX silver closed at $84 on January 30th, the Shanghai Gold Exchange was quoting spot silver at $122. That's a $37 premium, a 44% premium. In a normal market, premiums compress during crashes. Physical sellers panic and flood the market. Buyers disappear. Premiums go to zero or even negative, but not this time. After the worst crash on record, Chinese buyers were paying nearly 50% more than New York paper traders. Why? Because they understand that paper promises are worthless. Physical metal is what matters, and physical metal was nowhere to be found at COMEX prices. This creates a dangerous question. If Shanghai buyers are willing to pay $122 and COMEX is quoting $84, what's the real price? The answer is there is no single price anymore. The paper market and the physical market have diverged into parallel realities. One is based on ledger entries and leverage. The other is based on metal you can hold in your hand. And the gap between those two realities is widening every day. Let me give you context for why this crash happened when it did. January 26, 2026, the United States government was hours away from a shutdown. Congress was deadlocked over spending bills. Financial markets were nervous. Then the Senate passed a last-minute continuing resolution. Crisis averted. Except it wasn't. On January 29, Metropolitan Capital Bank and Trust in Chicago failed. It was closed by Illinois state regulators due to unsafe conditions and weak capital. Assets were $261 million. Deposits were $212 million. The FDIC took a $19.7 million hit. It was the first bank failure of 2026. One failed bank isn't a crisis, but it's a signal. Markets run on confidence. Banks run on trust. When the first domino falls, traders start wondering which domino is next. Polymarket, a prediction betting platform, had put the odds of a U.S. bank failure on January 31st at 99%. The crowd knew something was coming. Liquidity was tightening. Counterparty risk was rising. Credit conditions were deteriorating. In that environment, the initial reaction is always the same. Sell everything. Raise cash. It doesn't matter if gold and silver are supposed to be safe havens. In the first phase of a crisis, margin calls force liquidation of liquid assets first. This is the tragedy of modern markets. The safest assets get sold first because they're the easiest to sell. Illiquid assets like real estate or private equity can't be dumped in minutes, but gold and silver futures can. So when fear hits, the safe havens get hit hardest. This is counterintuitive. This is insane. But this is how financialized markets work. Everything is correlated to liquidity. And when liquidity dries up, everything falls together. But here's what the bears are missing. This crash didn't change the fundamentals. No new silver was mined on January 30th. Industrial demand didn't disappear. Solar panel manufacturers still need silver. Electric vehicle makers still need silver. The deficit between mine supply and total demand is still 800 million ounces per year. That deficit has to be filled from above-ground stockpiles. And those stockpiles are shrinking. The only thing that changed on January 30th was the paper price, the ledger entry, the digital illusion. Meanwhile, the Chicago Mercantile Exchange announced it was raising margin requirements on gold and silver futures. This is adding insult to injury. If you survived the crash and held your position, Now you need to post more capital or get forced out. Margin hikes after a crash create follow-on selling pressure, more liquidations, more volatility. It's a deliberate mechanism to shake out weak hands. The exchange claims it's for risk management, but the timing is suspicious. Raise margins after a crash, and you guarantee more selling, unless that's the point. Let me walk you through what JPMorgan did step by step. For weeks, leading up to January 30th, they had been building short positions, selling paper silver into a rising market. Every time silver rallied, they sold more. This created a ceiling. It frustrated bulls. It generated bearish sentiment. But more importantly, it created a massive short position that would eventually need to be covered. And the only way to cover a short profitably is to buy back at a lower price. So how do you guarantee a lower price? You create a crash. On January 30th, JPMorgan and other bullion banks unleashed a coordinated wave of selling. Hundreds of thousands of paper contracts dumped into the market in hours. This overwhelmed all bids. Prices collapsed. Stop-loss orders were triggered. Margin calls went out. Forced liquidations cascaded. Retail traders sold at any price just to stop the bleeding. And at the bottom, at $73, JPMorgan quietly closed 633 short contracts. They covered. They bought back at the low. Then the selling stopped. The pressure lifted. Prices recovered. JPMorgan walked away with profits on both sides of the trade. This is not capitalism. This is not free markets. This is manipulation. It's legal manipulation, hidden behind layers of complexity and plausible deniability, but manipulation nonetheless. The commodity. Futures Trading Commission knows this happens. The exchange knows. The regulators know, but the system is designed to allow it, because the banks that do the manipulating are the same banks that provide liquidity to the market. They're essential. They're too big to fail, and they're too powerful to prosecute. Think about the scale of this theft. $7 trillion erased from precious metals in one day. Where did that wealth go? It didn't vanish into thin air. Wealth doesn't disappear. It transfers. Someone lost $7 trillion. Someone else gained $7 trillion. And the ledger at JPMorgan tells us exactly who won. They timed the bottom perfectly. They closed their shorts at maximum profit. And they did it with inside knowledge of their own order flow. They knew where the bottom was because they created the bottom. Now let's talk about the long-term stackers. The 70% of people watching this who have been accumulating physical silver for years. For you, nothing has changed. In fact, this crash validated your entire thesis. You never trusted the paper market. You always knew it was rigged. You buy physical metal and you hold it. You don't trade it. You don't leverage it. You don't care about daily price swings. You care about generational wealth preservation. And from your perspective, this crash was an opportunity, a chance to acquire more ounces at a temporary discount. Because here's what you understand. Sovereignty is solvency. Nations that control their own resources and their own money are sovereign. Nations that borrow in foreign currencies and depend on foreign creditors are colonies. The same is true for individuals. If you own physical assets outright, you're sovereign. If you own paper claims and leveraged positions, you're a sharecropper. You own nothing. You're one margin call away from zero. The crash of January 30th was a reminder of that brutal truth. For the short-term traders, this was a disaster. If you were long silver on leverage, you were liquidated. If you had tight stop losses, you were stopped out at the worst possible prices. If you were overpositioned, you're massively underwater or completely wiped out. The technical damage is severe. Some traders lost more than they invested. They ended up owing their brokers. This is the risk of playing in a rigged game. The house always wins. But here's the unresolved tension. We just witnessed the biggest single-day silver crash on record. JPMorgan's positioning proves it was planned. But does this mean the bull market is over? Or does it mean the paper system is on its last legs? Is this the beginning of a new bear market? Or is this the final flush before the physical reality reasserts itself? The answer depends on what you believe about the future of money. If you believe central banks will tighten policy, inflation will fall, and trust in fiat currency will return, then precious metals have topped. The crash was the beginning of a multi-year decline. Sell your gold, sell your silver, buy bonds. But if you believe central banks are trapped, deficits will explode, and trust in fiat currency will collapse, then this crash was a gift. It was a chance to accumulate at prices that will never be seen again. It was the final capitulation before the endgame. The first bank failure of 2026 has already happened. Polymarket predicted it. It came true. How many more are coming? What happens when the next bank fails? What happens when liquidity tightens further? What happens when credit freezes? The initial reaction is always risk-off liquidation. But phase 2 is flight to safety. We're in the transition. The question is whether you have the conviction and the capital to survive the transition. History teaches us that empires don't fall because of military defeats. They fall because of balance sheet insolvency. Rome debased its currency. Weimar Germany printed into hyperinflation. The Soviet Union ran out of hard currency reserves. Britain bankrupted itself, fighting 2 world wars. Every collapse is a financial collapse first. The wars and revolutions come after. The ledger determines the outcome. And right now the ledger is screaming warning signs. The U.S. national debt is $36 trillion. Annual deficits are $2 trillion and growing. Social Security and Medicare are insolvent. The Federal Reserve's balance sheet is still $7 trillion after years of so-called quantitative tightening. Foreign central banks are dumping U.S. treasuries. The petrodollar system is fracturing. BRICS nations are settling trade in local currencies. The foundation is cracking. When trust in the currency fails, people flee to hard assets. Gold, silver, land, energy, food, things you can touch and use. This is not theory. This is history. This is what happens every time a reserve currency collapses. And the collapse always starts in the bond market. Interest rates spike. Debt becomes unpayable. The government prints to cover the deficit. Inflation accelerates. Real assets soar. Paper assets burn. We're not there yet, but we're closer than most people think. The crash of January 30th was a preview, a stress test, a glimpse of what happens when confidence cracks and liquidity vanishes. JPMorgan survived because they had inside knowledge. They timed the bottom. They closed their shorts. They walked away with profits. But retail traders got slaughtered, and the next crash will be worse. Because here's the thing about leverage. It amplifies everything. When prices rise, leverage makes you rich. When prices fall, leverage makes you bankrupt. And in a highly financialized system where everything is leveraged, a small shock can cascade into systemic failure. The crash of January 30th moved 1.98 billion ounces of paper silver. That's more than twice annual mine production. And it happened in one day. Imagine what happens when the paper market loses all credibility, when buyers refuse to accept cash settlement and demand physical delivery, when the COMEX defaults because there's not enough metal in the vaults to cover the claims. That's the end game. That's the moment when the paper price and the physical price diverge permanently. Shanghai is already trading at a 44% premium. What happens when that premium goes to 100%? What happens when you can't buy physical silver at any COMEX price? What happens when the ledger reveals that the emperor has no clothes? JPMorgan knows this is coming. That's why they closed their shorts at the bottom. They're repositioning for the next phase, the phase where paper burns and physical soars. They're not stupid. They're not caught off guard. They're the smartest players in the game. And the fact that they covered at $73 tells you everything you need to know. The bottom is in. The manipulation is complete. The next move is up. So here's the lesson. The ledger always tells the truth. You can lie with words. You can manipulate with headlines. You can deceive with narratives. But you can't lie with numbers. The COMEX report, dated January 30th, 2026, shows JPMorgan closed 633 silver shorts at the exact bottom. That's the proof. That's the smoking gun. The crash was planned, the bottom was engineered, and the recovery was inevitable. $7 trillion erased, biggest daily loss on record. First bank failure of the year, 1.98 billion ounces of paper dumped in a single session. And JPMorgan walked away clean. This is how the system works. This is how wealth transfers from the ignorant to the informed, from the leveraged to the patient, from the paper holders to the physical stackers. If you're still watching, you're part of a small group that understands this game. Most people will never see this. They'll read headlines about market volatility and move on. They'll trust the experts who tell them everything is fine. They'll keep their wealth in banks and brokerage accounts and paper assets. And when the system finally breaks, they'll lose everything. But you won't. Because you understand that sovereignty is solvency. You understand that the ledger determines the outcome. You understand that paper is a promise and physical is property. And you understand that history doesn't repeat, but it rhymes. Every empire that debased its currency collapsed. Every reserve currency that printed without restraint failed. Every financial system built on leverage and fraud eventually imploded. We're living through the next chapter of that story. The crash of January 30th was a page. The closure of JPMorgan's shorts was a footnote. But the ending is already written. It's written in the ledger. And the ledger doesn't lie. Subscribe to this channel so you're ahead of everyone else who doesn't know the history, because the ones who know the ledger inherit the wealth. The ones who ignore it lose everything. The choice is yours.